Financial Modeling, Topic 13, Forward Contracts and Hedges, Simulated Correlated Random Variables by Lou Gaddis. References include these from Wikipedia on forward contracts, cost to carry, and from the Chicago Mercantile Exchange on futures, and also some at-risk information on generating correlated random variables. In this topic 13, we're going to understand forward contract structure and use, compute theoretical forward prices for equities, currencies, commodities, calculate the forward payoffs, and construct forward hedges using beta and correlation, simulate forward hedging strategies, and then simulate cross-hedging strategies using correlated randoms in at-risk. So let's start with topic 1, understand forward contract structure and use. A forward contract is simply a contract to buy or sell an asset in the future in which the asset price, quantity, and delivery location are specified in the contract. There's generally no upfront payment. It's simply a signing of a contract. At maturity, the seller of this contract is obligated to deliver the asset to the buyer and is paid the contract forward price that is specified. The forward contract terms are negotiated between the counterparties in what is called the over-the-counter market, or the OTC market, which is simply a network of institutions. Futures contracts are simply forward contracts that trade on exchanges such as the Chicago Mercantile Exchange. The assets used for forward contracts include stocks, both individual stocks and index portfolios like the S&P 500, bonds, primarily treasury bonds, currencies, and commodities, including precious metals, gold, silver, etc., livestock like cows, pigs, and chicken, agricultural products like corn, wheat, coffee, cocoa beans, and fuels such as oil and gas. The uses of these contracts include hedging. These first two examples are hedgers. You could lock into future prices, in other words, lock into your costs. So example, Starbucks could use forward contracts to lock into the price of or the cost of coffee beans. Hershey could lock into the cost of cocoa or chocolate. Southwest Airlines could lock into the price of jet fuel. And investors could lock into the purchase price of an individual stock or a stock portfolio, again, like the S&P 500. All these people would take a position in the contract in which they are the buyer of the asset. You could also lock into future sales prices or your revenues. So a farmer could enter into a forward contract to sell all of their agricultural products, either livestock or grains. An energy company could enter into a forward contract to sell their oil or gas. And again, investors could lock into a sale price of an individual stock or a stock portfolio. However, there's another class of people that use forward contracts, and those are speculators. You could simply enter into a forward contract today and then a spot purchase or sale at maturity to try to earn profit. For example, you could enter into a forward contract to buy some commodity at some price F, the specified forward price, and you will profit if at maturity the spot price is above the forward price. And if that's true, you'll use the forward contract. You're required to buy at F, and then you'll sell the asset into the spot market and earn profit again if S is greater than F. The spot price is greater than that forward price at maturity. So in this topic, we simply talked about forward contract structure and use. In the next topic, we'll talk about how to compute theoretical prices for these forward contracts.